Ever wondered what shares are all about? Let's break it down. Picture a company as a large, delectable pie. Each slice of this pie represents a share. When you buy a share, you're essentially purchasing a piece of the pie, or in real terms, a part of the company. This makes you a shareholder, an owner of a fraction of that company, whether it's a sliver or a larger chunk. Now, why would a company slice up its pie? Well, shares are a way for companies to raise funds. Rather than taking on debt, they sell pieces of their business. This money can then be used for various purposes, such as funding operations, innovating, or expanding. So, in a nutshell, a share is more than just a piece of paper or a digital entry. It's your slice of a company's pie. You're not just buying a share, you're buying a piece of a business's future. Did you know there are different types of shares? That's right, not all shares are created equal. Let's dive into the two main types, shall we? First off, we have common shares. These are the most typical type of shares you might think of. When you buy common shares, you're essentially buying the right to have a say in the company. You get voting rights at shareholder meetings, and you might even receive dividends, which is a portion of the company's profits distributed among shareholders. The other type of share is preferred shares. These shares don't usually come with voting rights, but they do have their perks. Preferred shareholders get dibs on dividends before common shareholders. And if the company goes under, preferred shareholders are higher up in the queue when it comes to claiming any remaining assets. Common or preferred, each type of share offers different benefits. How do you buy or sell shares? Well, the action happens on stock exchanges, such as the New York Stock Exchange or the Nasdaq. These are like bustling marketplaces, but instead of buying vegetables or clothes, investors trade shares. These exchanges operate throughout the day, and just like in any market, the prices of shares fluctuate. They rise and fall based on the laws of supply and demand. As an investor, you buy shares hoping their price will increase over time. If that happens, selling those shares would net you a profit. This is often referred to as capital gain. But there's another way to make money from shares: dividends. Some companies distribute a portion of their earnings to shareholders in the form of dividends. So if you own shares in such a company, you could receive a regular income. Remember, trading shares can be a way to grow your wealth. But just like any investment, it requires knowledge, patience, and a fair bit of courage. What are the risks and rewards of investing in shares? Well, it's a bit like a roller coaster ride. There are thrilling highs and, yes, potentially stomach-churning lows. The rewards can be significant. Many investors have built their wealth by investing in shares. When a company performs well, its share price can rise, giving shareholders a tidy profit when they sell. Plus, many companies pay dividends, which is a portion of their earnings distributed among shareholders. But remember, the ride isn't always smooth. The value of shares can go up and down. Factors like company performance, market trends, and economic conditions can cause share prices to fluctuate. That's why it's crucial to do your research, understand the companies you're investing in, and if possible, get advice from financial professionals. Investing in shares can be rewarding, but it's not without risks. That's a quick look at shares for beginner investors. We've journeyed from understanding what shares are to exploring their types and the dynamics of buying and selling them. We've also touched on the potential risks and rewards. Remember, each share you buy is a slice of a company that you own. As with any journey, the world of investing is filled with learning opportunities. So keep exploring, keep learning. Remember, investing is a journey, and it pays to be informed. Thanks for watching.